Okay, this video we will walk through some of the different cost accounting computations, and really you kind of have to understand the terminology and kind of that how that all flows through that cost of goods manufactured schedule. So in this one they give us some information that is for the current year, but again we're missing a lot of like beginning balances and certain numbers, so they're making us back into it. So the first thing they ask for is your direct materials used. So normally what you would do is you would take your beginning balance of your direct materials plus your purchases minus your ending balance. But as you look through here, we have our ending balance and we have our purchases, but we don't have the beginning balance, so we can't jump to that. So then we have to look at it and say, okay, well, what else do they give us that we could figure that out? So as we look through it, we have our total manufacturing costs. We have our prime costs. So 466,600, so 466,600. And our prime costs are our direct labor costs and our direct material costs. So then if we subtract out the direct labor, 184,000, that leaves us the 282,600 for our direct materials used. Well, then now that we have what was used, we could back into what the beginning inventory must have been. So if we used up 282,600, and we have plus 52,000 at the end of the year, we would have had 334,600 available. But again, we used up minus 282,600. That's going to take me back to the ending balance. So sorry, that takes us back to the 52,000. I got to go the other direction. So we used up, okay, so we got to say our purchases, we know what we purchased, 263,200, and then minus that from what was available. So then what was available was the 282,600 plus the 52,000 at the end, and then now subtract what was purchased, 263,200, and that gives us the 71,400. Our conversion costs are all the costs necessary to convert that, raw materials into a finished good. So we know our direct labor costs and we know our direct material costs, and then we have our total manufacturing costs. So we don't, so if we go down, let me go down to those ones. So we have to take our total manufacturing costs of the $914,400, and then we have to subtract out the 466,600, those prime costs. So 914,400 minus the 466,600, whoops. And then we have to add back the 184,000 of direct labor costs. And that will give us our conversion costs. So our prime costs, our total manufacturing costs, and then subtracting out our prime costs, which again are our direct materials and our direct labor, and then add back that direct labor. So then you get the 631,800. Then our work in process inventory, what do they give us for that? We have the beginning inventory of 26,200 plus our cost of goods manufactured 906,600. That gives us 932,000 available. No, and I did that, sorry, I did that the reverse. So that we want to take the beginning work in process, the 26,200 plus the 914,400, the total manufacturing costs, and then subtract out the cost of goods manufactured, which then would go into our finished goods inventory. And that leaves us the 34,600. So our manufacturing costs for the period plus our beginning work in process minus our cost of goods manufactured, because again, that's what moves over into our finished goods. Our manufacturing overhead, we are going to take our conversion costs and subtract out our labor, direct labor. So our conversion costs we calculated here above, so the 631,800, and then subtract out our direct labor, and that gives us the 447,800. And then now our finished goods inventory, again, the beginning balance. So we know that we added the 906,000 to it, and then we ended up with cost of goods sold of 727,400. That would have come out of it. And then we also ended up with 236,400 left in our ending inventory. So then we're going to take the 727,400, our cost of goods sold, and then we are going to add our ending inventory, the 236,400. So that's what would have been available, and then subtract out that cost of good manufactured. So that's what we would have started with. So again, when we're backing into those ones that we start with, it's a little harder to kind of map it through. It's almost easier to write those, like kind of write that schedule down and then mathematically back into it. Okay, then now here we have unit prices for some of the things. So we have a sales price per unit, direct labor per unit, direct materials per unit, variable overhead per unit. Then our fixed things are given to us for the month, and then we have marketing and selling price per unit. So they'd like us to calculate out our variable manufacturing cost per unit. So we'd have our direct material of $137, our direct labor of $44, and then our variable manufacturing overhead of $86. And that gives us the $267. The full cost per unit is also going to calculate that fixed overhead into that. So if we have $62,250 divided by 750 units, that's $83 a unit that we'll have to add in to our $267 a unit. And then we also have to factor in our marketing and administrative. So that's $17 per unit. And then our fixed costs there, I guess I probably should have added those together. All right, so let's go back and do that. So 62,250 plus 83,250. Our total fixed costs are 145,500. Divide that by the 750 units. That gives us $194 plus the $267 that were our variable manufacturing costs, and then plus our $17 of variable marketing and administrative. So that full cost is everything, again, though calculated as a per unit basis. Then our variable cost is same as our variable manufacturing, but now we're going to add the variable selling, that's $17 to bring that up to the $284. The full absorption cost per unit is going to be the $62,250 divided by the 750, that $83 a unit plus the $267, which was our variable manufacturing. So it's really just all of the manufacturing costs, but again, put into a per unit. Our prime cost per unit is our direct materials and our direct labor. So it's 181, the 44 and the 137. Our conversion cost per unit is our overhead and our labor. So 44 plus 137 plus 86 gives us, not that, the 267. All right, so 213, so 130, no. So $83 we have for our fixed costs, 86 for our variable costs, and then 44 for our labor. So 213, yeah. Thought that's what I did the first time, but my math didn't work out. So the fixed overhead per unit plus the direct labor per unit and the variable overhead per unit. So we don't calculate the materials because how much does it cost to convert the materials is what that's saying. Then our profit margin per unit is going to be our $695 selling price minus all of the costs. And so all of the costs are that full cost per unit. So minus the 478. And that gives us the 217. Our contribution margin is our selling price, $695, minus our variable cost per unit, which is the 284. So that's 411. And then our gross margin per unit is our selling price minus our cost of goods sold, which would be our manufacturing costs, which are the full absorption. Is that the one? Yeah, the full absorption. So the full absorption has all of our manufacturing costs. So our selling price minus that full absorption gives us our gross profit margin per unit. Okay, then preparing these statements. So this is a good one though. I would have these statements written out as you're doing your homework and as you're working on these problems. Because again, they give you this whole list of information and you've got to figure out kind of where do you put it in. So I'm going to just kind of walk through it here. I would have this printed out and in front of you so you know the right format. So our statement of our cost of goods sold, we always start with our beginning balance of our work in process inventory. Then over to the left, we look at, well, what happened in our direct materials? So our beginning balance for our direct materials plus purchases gives us what was available, less our ending inventory gives us our direct materials used. And then those would be going into our work in process. And then our direct labor is going to go into our work in process. Obviously, it's no part of our direct materials. Then we map out, well, what happened in our manufacturing overhead. Now, sometimes this is just given to you as a dollar amount. In this one, you've got to go back up here and look through the list and say, okay, what is all included in our overhead? So our depreciation factory, our depreciation on those factory machines, our indirect labor factory, our indirect materials factory, our property taxes factory, and our utilities factory. So let's go down and double check. So you notice all of those just say factory. So we're not factoring in any of the administrative offices, any of the selling and the marketing. So then we total those up, and then that is our total manufacturing overhead. So our direct materials plus our direct labor plus that manufacturing overhead gives us our total manufacturing costs. We add that to the beginning balance of the work in process to get to our total work in process at the end of the year. And then we subtract our ending work in process, what's still in our warehouse or on our floor or whatever. And that gives us our cost of goods manufactured, which then adds into our finished goods inventory. And that gives us our finished goods that are available for sale. Then we subtract out what finished goods we still have on hand, and that is our cost of goods sold. So then that is our schedule to prepare that cost of goods sold. So then we come over here, and that's going to go into our income statement on that second line item. So again, we'll go back up. They tell us the sales, let's see here, down here. Okay, so sales revenue are $70,927. Our cost of goods sold, again, is what we pulled off of this first schedule. And that then subtract those to get to the gross profit, the gross profit margin. Then we look at those general and administrative expenses. So the depreciation on the administrative costs, depreciation on the corporate building, property taxes on that corporate building, then our selling costs. So then you'll see all those listed out, total those up, and then they have an operating loss. So those two things you want to be able to do, and to kind of, I'd have them kind of printed out and in front of me because there is a lot of details to those. Okay, then we have a product that we're going to try to allocate some costs to, I believe, in this one. So they produce a product made with metal alloy. They have two suppliers who supply it. Neither supplier can meet their demand because of capacity constraints. The material from Leibold is less expensive to buy but more difficult to use, resulting in greater waste. The metal alloy is highly toxic, and any waste requires costly handling to avoid environmental accidents. Last year, the cost of handling the waste was $1,597,200. So here they give us the amount purchased and the amount of waste, and then the cost of the purchases. So we want to allocate that cost of the waste to the two suppliers based on the amount of material purchased. So for that first one, if we purchased 67.8 from Leibold, 118.2 from Cecil, we have 186 total. So then now calculate a percentage of that. So 67.8 divided by 186, that gives us 36.02%. So if we multiply that by 1597200, we would allocate 575. Again, my rounding's probably a little different than theirs. What did they tell us to round to? Do not round your intermediate calculations. So let it all go out. And then so we're allocating it based on those percentages based on what was purchased. Now, what if we allocated it on the amount of waste? So then we've got the 10.5 plus the 12.5. So we've got 23. So then 10.5 divided by 23 gives us 0.4565. Again, don't round it. We'll leave it go out, all those decimals. Multiply that by the 1597200. and that gives us 729,157. So now I'm good that I didn't round. So then we allocate it, again, based on those percentages. Then the cost of the material purchase, again, do the same thing. So the 1,980,528 plus 4,408,272, and that gives us 6,388,800. And then we'll take that and then divide that into, so 1,980,528 divided by 6,388,800, and that gives us 0.31. That one I don't have to worry about rounding. Multiply that 0.31 times 1597200, and that gives us 495,132. So again, it's one of those, you just got to read it carefully to figure out how are we allocating these costs. Make sure you pay attention to the rounding, let it go out all 9 decimals, and then calculate that out.